thanks for joining. Yeah, you can see Harry's joined there, guys. So really appreciate you joining on the webinar today. Thanks, Harry, for coming along.
Thank you for having me.
So just a kind of bit of a heads up on why we've sort of looked at doing this webinar. We've done a lot of webinars on, really about job costing, winning work, winning profitable work, all that kind of stuff. But with kind of what's going on with the economy and, really the world economy and in particular things of interest rates and the pressures that are on just ordinary people, as well as builders. I kind of wanted to do something a bit more targeted at those kind of issues. And Harry's absolutely amazing for that. I've been at numerous events with Harry and some of our partners, and yeah, I've seen a heap of. So I'll just turn the YouTube video off there before it starts playing another song. Yeah, I've seen Harry present a number of times, and he's got some great advice for a lot of the events that I've been to are for young builders that are just starting out, Harry. But obviously, great advice for people to take on board now, and things to do to safeguard your future in your business. Some of the points I've seen that Harry's going to be making, I'm taking on board as well. So I'm going to make some changes in what I'm doing. So yeah, I'll let Harry do a proper introduction of himself, and we'll get going. And just some housekeeping, guys. If you have any questions, just feel free to pop it into the Q&A box or the chat box. Ideally, the chat box is easier just for everyone to kind of communicate things like that. But I know some people prefer to put it in the Q&A. Just if you do put it into the chat box, just make sure that you select the everyone box, because sometimes people just send them directly to us, and it's great if we can kind of let everyone see them at the time. We'll try and answer questions that are on point as we're going through, but I'll kind of try and be a bit of a gatekeeper for Harry, so he doesn't have to keep on looking at them. But generally what we try and do is have a big Q&A section at the end. So, there's going to be heaps of conversation on this stuff about, interest rates and things like that. So if you have any questions ready, just, jot them down or even enter them into the chat, and we'll cover them off as we get to it. But I'll pass over to Harry now to take away.
Wonderful. Thank you, Julian. G'day, everyone. Hope you all had a wonderful long weekend if you're in Melbourne, and you managed to stay dry and even back a winner, hopefully. So I'll just share my screen.
If you want to back a winner, never back who I back. That's my rule of thumb. I don't think I've ever won. Well, I don't think I've even got into the top three for that race. So
yeah, I've stopped trying as well, Julian.
Yeah.
Well, I'll keep that in mind. So as Julian said, my name is Harry Pontikas. I'm from Chocolate Money. Chocolate Money is a finance broker that's been helping to fund the building industry since 2002, 2003. As a result, we get to see from inside out what makes a successful business, specifically in the construction industry. And we also get to see businesses that you just can see are not going to do very well moving forward. So I'm hoping to be able to share some of the insights and the tips that I've accumulated over the last few decades, and help you navigate through the current crazy times. I've got to tell you, it's just nuts at the moment, but let's get right into it. Some of the key takeaways that I'm hoping I'll be able to impart from this session is that hopefully most of you at Melbourne Cup and missed the fact that the interest rates went up again yesterday for the 7th consecutive month in a row. That's after the Reserve Bank governor said that there wasn't going to be any interest rate increases until 2024. So what it means for you, what it means for your business, what impacts the continuously rising interest rates will have on your clients, how property prices and properties in general will be impacted, and what you can do proactively to safeguard your business in just the rising cost pressures that are upon us every single day now, and are just getting worse, and are forecast to continue getting worse in the near future. So other practical tactics that you can deploy when your clients are having issues with their finances and are struggling to pay for either the new job they're about to start or their existing job that's underway, and how to choose the most profitable projects and what you can do about that. So Please note that the information that we're discussing in this workshop or this webinar is general in nature. It's not to be considered specific advice. Obviously, I don't know your situation, so I'm unable to tailor the advice specifically for you or your business. Feel free to contact me afterwards should you want specific advice regarding lending and credit. And Chocolate Money does hold an Australian credit license with the number below. Okay, so let's just go wide and then we'll narrow it down. So some of and we won't spend too long on these things because I'm sure that everyone's across them, but the things that are the global factors that are contributing to the storm that we're finding ourselves in. Obviously, the war in Ukraine is having massive issues on the availability of food, grains, and is causing a lot of turmoil to supply markets and distribution chains. China's continuous lockdowns for COVID. Even Disneyland got shut down again, I think yesterday or the day before, after being closed for 3 months. But the rolling lockdowns does have an impact on the global supply chains again. COVID. Who isn't sick to death of hearing about COVID? I know I'm sick to death of hearing about COVID, but I still got to mention it because globally, COVID and nationally and locally, COVID's still a thing. There's a new strain that's out that doesn't seem to be affected by the current vaccines. And if you've had COVID before, the antibodies aren't doing anything for this new COVID strain. So I won't.
You're not going to try and get us to wear a mask again, Harry.
Hey, I'm not trying to get you to do anything, but I know with the builders that I work with, COVID seems to be a rabbit out of the hat. They pull it out. I can't come on site today because I've got COVID, but I'll be fine tomorrow. Which, by the way, now with no quarantine restrictions seems to be okay to do as long as you don't have symptoms. So I'm not here to tell you what to do or what not to do with COVID, but I know it's causing massive disruptions locally on sites, but obviously globally. 2022 was the highest death rate during this whole pandemic, and it's looking to get worse, but I'm done with it. I'll leave it to experts to talk about COVID, but it does cause massive issues globally and is continuing to cause a lot of hiccups on sites.
I think we'll come into this a bit later on, Harry, with the COVID stuff, but I think, I was a backpacker once. If you haven't heard from my accent, guys, I'm from the UK, which we'll come to the UK turmoil in a second. But, just the labour market, even for, there's problems with labour shortages everywhere. But, backpackers occupied so much in the hospitality space and things like that. So, when you lose most of your backpackers and, you used to be able to get a return flight from London to Melbourne for $1,400. And, I try to get my parents over at the moment for Christmas and it's sort of $3,000-$4,000. So it's gone up a heap. So, they haven't got as many, the workforce coming from abroad as they used to. And I think the farms and stuff are the same issues as well.
Absolutely. As well as labour on site is an issue, just unskilled labour. It's not very often you see the white vans pull up, the door slides out and 20 people pile out to just knock over a job. That sort of, you don't see that as much anymore due to the labour shortages. But globally, there's supply chain delays, production delays, and even more in our area, in the Asia Pacific area, tensions over Taiwan. I think the US is parking a few nuclear capable B-52 bombers in Darwin. So that doesn't add to a positive investment environment. UK, as you mentioned, Julian, is a schmozzle. I don't know how many prime ministers they've had in the last how many months, but
there was a trash newspaper from home that I remember, when I was growing up, and they had a thing that what could last longer, a lettuce that was left out, or as a photo of Liz Truss, and they just had like a countdown of who would, and obviously the lettuce lasted longer, but
Wow. Yeah. So UK is just a mess. Europe, they can't turn anything on, like the electricity, gas supplies, shortages. They can't even get woolies anymore, like winter warmers or thermals. They're all sold out and they're getting into winter. So Europe's going through quite a bit of a tough time at the moment, and America's still a basket case with skyrocketing inflationary figures. So anyway, on a global scale, on a global stage, we're not okay. And even here domestically, we're pitching to $1 trillion of government debt. We're not that big in Australia, but $1 trillion is a lot. We're still working through the COVID hangover, production shortages, delivery delays. We can't find people. And so the people that we have got, we have to pay more. I don't know whether anyone on this webinar has realized that trades are getting much more expensive. Constant price rises. So I'm being told that on delivery, the price goes up 5%. So they're about to, as they're offloading the windows, the guys are saying, oh, well, sorry, but it's gone up 5%. I mean, as a builder, what do? You just cop it. The inflation rate is not getting any better, even though we've had 7 consecutive interest rate rises, which, of course, we're having interest rate rises. And we can't find people. There's full employment. The unemployment rate is indicating there's full employment as well. So that has the added impact on sites where you can't hire people and you can't fire them because you can't replace them. Now, very specifically for the construction industry, we're still getting the hangover and feeling the effects of hangover of years of, I suppose, people being incented to construct and renovate, and the government giving hundreds of thousands of dollars as incentives for people to do this during COVID. And so a lot of builders just signed people up left, right, and centre and thought, oh, we'll work it out when we get to it. Unfortunately, we got to it. And with the rising prices and trades and the lack of materials and the labour increases, the margins on these fixed price building contracts that were signed up a year or two ago are close to zero. And you've heard of big volume builders that had to pay people to get out of the construction contract because they weren't going to make any money on it and was going to put a lot of financial stress on the business. So there's little to no margin left in jobs, especially if they were signed up pre-7 months ago. Material shortages causes delays on site, which means that for every day it costs you money. There's labour shortages, skyrocketing costs. A lot of clients are also feeling the pinch now. So they're unable or unwilling to keep up with the rising costs. I think I mentioned for every $1 million, it'll cost someone an extra $1,500 net to service that same loan. So they'd have to earn another, I don't know, $2,200, $2,300 a month to be able to afford the same loan they could afford 6 months ago, $2,000 less than what they have to pay now.
Harry, on that one, because I know a friend that's, it's got about $1 million loan, and I think they went on the upper end of what they were allowed to borrow when the interest rates were really low. So obviously that's going to be more of a struggle for them. They're luckily fixed for a while, but obviously when it comes off fixed back to variable, it's going to jump up. But just kind of one of the things that I didn't talk about when we kind of spoke earlier on was an average couple on a roughly average income with a semi-decent deposit previous, what were they looking at purchase price? My gut feeling is probably about, with the low interest rates, I'm imagining most people will probably get to the 7, maybe 8 with those low interest rates.
7 or 8%.
$700,000 or $800,000 property price.
Yeah.
With those low interest rates. And I'm just wondering what impact that has now and how many people are now out of the market because they physically can't even get a loan anymore.
Yeah. In December last year, the banks tricked up their serviceability calculators where you could borrow 5% less than what you could pre-December last year. The rising interest rates, which they get priced into the calculators, also have buffer rates that are getting tricked up as well. So it's not just the 6 or 7% that banks are using to calculate whether you can afford a loan or not. They're also loading another buffer rate on top of that. So there's a significant portion of the population that got into the market 12 months ago that would have no chance of being able to access that sort of loan today. But having said that, those people got into the market 12 months ago and are now having to repay that loan or look at defaulting or looking into going into arrears or hardship. Like it's putting significant pressure on people that 12 months ago could easily afford those loans because no one saw these interest rates going as quickly as they have gone. Well, in fact, we were all assured that the interest rates would not go up at this rate for, last year we were told 2024. So there was a lot of time that people had to figure out how they were going to deal with it in the coming years, whereas that just got sprung on a lot of borrowers. And that means that a lot of people that thought they could borrow X amount to buy, build or renovate can no longer do that, which of course dovetails into the demand for construction is falling. Yeah. Now at this stage it's falling, but it's forecast to fall significantly because people can't afford to borrow what they thought they could borrow, and they don't want to do half a construction job, especially when it goes something along the lines of you go to a builder and say, how much will it cost? And the builder says, look, I'm not sure, prices are increasing around 20%. So I'm going to have to build in a margin, a significant margin. And then the consumer says, oh, when do you think you can start? And the builder says, I don't know, the projects are all delayed. So when I find a spot, I'll start. And then the consumer says, so when will you finish? And the poor builder's saying, well, I'll finish as quickly as I can, but I'm not sure when I'm going to finish. So the recap is you don't know how much exactly it's going to cost. You don't know when you can start. You don't know when you can finish. You can understand why some consumers are saying, I'll hold off until this insanity calms down. And for the poor builder that's in this, that's their life. So things are a little bit uncertain and challenging at the moment. Property prices are also stabilising in Melbourne and are falling quite significantly in other parts of Australia. Like in Brisbane, I think the latest numbers are saying that they've come off 2%. Having said that, they went up around Australia anywhere from 15 to 20% in the last 2 or 3 years. So you're still okay. But, quite a few people have never seen property prices stagnate or come back at all during their lifetime. Because it's getting harder to borrow, it means it's getting harder to buy or build or renovate, which has the impact on the building industry of cooling everything off. Anyway, I won't dwell on too much of the negatives because I think we're done with the negatives as well, and everyone has a basic understanding. And many people on this webinar, unfortunately, are living this as their day-to-day lives. So we'll move on to the positives, what you can do to survive and even thrive in this environment. So the first step is protect your income. So get your insurances lined up. If you're earning X dollars and you're okay at the moment, make sure that you've got income protection to cover you in case things get really bad really quick in the foreseeable future. There's a lot of things that were let go during COVID. And so you might have subscriptions to Stan, you might have subscriptions to Netflix, et cetera, Now's a good time to think about taking stock on your expenses and freeing up some of the cash flow. Now, the significant cash flow freeing up will happen when you consolidate personal loans, credit card debts, car loans, all the stuff that you may have built up over the last few years and the standalone debts. If you consolidate them into your mortgage, it frees up thousands of dollars each month. You need to consider doing it because we know that you're going to need cash flow personally due to the rising interest rates and the rising prices. So please consider doing it sooner rather than later. Again, speak to a professional finance broker to see what impact it'll have on your cash flow. I know everyone spruiks refinance and chase a cheaper rate, and even it was on the news again this morning. That may not be a good answer for many people. What you don't hear is the banks and lenders front load all the interest payments on your mortgage up front. That means that the first, 70% of your mortgage, the life of the mortgage, you just spend paying down interest the interest to the banks. So every time you refinance, you reset that and you pay again predominantly the interest rate to the bank. So year after year of mortgage repayments doesn't mean that you're having any significant impact on the principal or the amount that you've borrowed. In fact, you're just paying back interest. So just don't be so quick to jump on the refinance bandwagon. I know that's how banks make money. I know that's how brokers make money, by refinancing you as the go-to solution. But just be mindful that in the current climate, I know that at Chocolate Money, we were able to 9 times out of 10 negotiate with the existing lender and the existing bank to lower the interest rates that you're paying, because banks know that if a broker's involved, most brokers will automatically just want to take you somewhere else. Whereas at Chocolate, we sort of say to the bank, this is the lowest interest rate, please match it or we'll take your client elsewhere. Again, 9 times out of 10, the bank will match it if a broker's involved. So refinancing is not always the best option or your number one option go to. Access equity. So if you've got any equity in property, whether it's your house or investment properties, now's the time to have it sitting there as a safety net. The best time to borrow and set up these safety nets is when you don't need the money. So if you're fully cashed up, your income's coming in, the jobs are all going well, and you're thinking, I don't need the money, now's the time to consider cashing up. When you've run out of money and things are really looking really bad and very grim, that's not a good time to borrow money, because most lenders will see that and say, things are looking really bad for you. Now's not a good time for you, and we're definitely not going to take a punt by giving you money when you're struggling so badly. So I know it sounds a little bit counterintuitive, but consider accessing equity and accessing funds, especially if you don't need them at the moment, because we can all see things are not going to get better in the short term, and we're entering even rougher and stormier waters. Revisit your budget, cut costs, as I said before. Look how much you spend on groceries, look how much you spend on subscriptions. Just take stock of your situation at home. Get yourself in a robust and positive position as you enter the stormy waters. Your business in many ways is similar to your home protection and steps that you can make or take. So get your insurances in order. Consolidate debts, access funds as safety nets. Most importantly, make sure that you get onto the nuts and bolts and the fundamentals of your business. Make sure that your business is running the way it should run. Cut costs, increase your revenues, pull in claims early if you can, push out invoices late if you can as well. Look at mitigating your risks, capitalizing on opportunities. Get dashboards set up for your business. So a lot of software platforms like Buildxact do that for you, but you must have a dashboard or a scorecard where at a glimpse, any time of the day, you can see what the key risks are to your business and therefore take steps to mitigate those risks. Now, specifically with running your business, people are the biggest costs to your business, but are also the biggest asset to your business. So make sure that they have crystal clear clarity on what their job entails. For example, if they're a site supervisor, site manager, project manager, construction manager, their targets are pretty clear and transparent. It should be delivery of the project on time, on budget, within the quality or specifications required, with zero harm happening on site. So that's their targets. Their key performance indicators that you can measure them on each day and each week are things like, are they running toolbox meetings? Are they running safety walks? Are they filling out quality checklists before you let a trade or a subby go off because he's nearly finished? So he says, I'll wrap it up tomorrow or the next day. That's not the way to run an efficient business. So make sure that your teams are very skilled, they're trained and motivated to do the work, because you need to make sure that you stop running overtime in regards to things that you control. So making sure trades appear on time, turn up when they're meant to turn up with the right number of people when they're meant to turn up. So having systems and processes in place where you're ensuring that the trades are turning up on time every time, that the systems and processes provide a framework for your people to operate within, ensure that they're all marching to the beat of the same drum and they know what they're trying to achieve every single day. And it's very outcomes focused, not just rocking up on site and here's another day and they make another dollar. So cash flow will be the death of many building related businesses after Christmas. So December, January, February, we're going to see a massive influx of profitable businesses going broke because of cash flow. Please make sure that you're not one of them. And if you weren't sure that you heard correctly, profitable businesses will go broke because they run out of money throughout the cycle. So not because they're not making money, but because they run out of cash. Please don't be one of them. It's one of the biggest risks in the building trade.
I think, Harry, that comes back to your point earlier on about, why you should access the funds now, why you can and why you can still get a hold of them to provide that safety net if you do have any issues.
Absolutely, Julian. The worst case scenario, if you get your business in shipshape order now and it's running well and you've got cash reserves that you don't ever need to use, the worst case is you're just going to make more profit. You're just going to run well. And so there's no downside, Julian. The downside, though, of not doing that, of not having a financial safety net and not running your business on time, on budget, and running every project that way could be catastrophic. And that does run into your personal life. So one of the testaments to the grit of the building industry is when things get tough and times get tough, most people in the industry put their head down and just grind harder. They just work on site. They pick up the tools, even if they were off the tools before, and they just push. In this environment, that may not work because there are so many other factors that will impact you. So having an understanding of the factors that are beyond your control and letting them go and tightly managing the ones that are within your control is what's going to get you through this time. Clients. Now, the financial pressures that we're talking about are faced by clients as well, not just those in business. So clients will be able to borrow less. Clients will have to pay or find an extra $1,500, $1,600 more each and every month that they didn't have to find the month before. So clients will be looking for ways to be creative with funding. Clients could also trigger banks reviewing their pre-approved loans. So, for example, if a client goes to a bank and says, "I want a car loan," and the bank says, "Oh, sure, no problem. We'll just do an update of your statement of position." Under the current serviceability regime, they may not be able to afford the line of credit or the funds that they were going to use to finish their construction project. And the bank has a responsibility to not load them up with existing debt. Not to leave them with existing debt if it's going to cause financial hardship to those clients. So the outcome and the tools that the bank has is never pleasant for the consumer. And it's sure not going to be pleasant for the poor builder that's halfway through the project where the client's looking to cut back or lower costs or, de-spec, I suppose, a build that you've already ordered the materials on, as an example. So that's some of the things that are impacting your clients. Your future clients as well will be under the same stress, where they may have been able to borrow $1 million yesterday, whereas today they can only borrow 800, is a huge impact that it's having on clients. Now, I'm not going to mention the clients that aren't very nice, where they would I wonder how long my builder can hold on without the last payment being made, without going broke. Those people do exist, unfortunately, and the poor builder that's finished the job and handed it over, and the last payment is due, and the client's just curious and withholds payment. Or it could be an authentic dispute where the client says, I'm sure the building regs, who's only built one house and that was it ever in their whole lifetime, is quoting building regulations to you, but says, oh no, they're not up to regs. And you're saying, oh, they are. And there's a dispute that happens that then goes to VCAT, and you're sitting there trying to hold on to that debt thinking, oh my goodness, I've got all these other projects that I need to move along, but unless I get the claim paid, I'm in financial trouble. So those clients unfortunately do exist.
I've heard as well, Harry, that I speak to a lot of builders, and I've been at a lot of events and stuff, and I think a lot of people are adding quite a decent margin on top now. So in terms of you kind of touched on this, in terms of the profitability of the projects, they're really profitable jobs, because I think material prices have stabilized a little bit. I think they're still going up. They're not kind of doing that same stupid climb that they were doing a year ago or so. But kind of what you're saying about the cash side of it, and people are actually everywhere are getting told where you can to delay payments. Everywhere that's been told to everyone, left, right, and centre. So I'm assuming people are doing that as well. So you've got this project that's really profitable because you've added a really big buffer on it, and maybe you've expected the material prices to grow at a higher rate than they actually have, but because you can't get the payments through the door, that's what's likely to hurt people. And that's kind of where I kind of forgot the point earlier on I was leading to about having that cash available, because in this sort of time, in any difficult time, it brings out more
worse in people, maybe
more arseholes. I'm going to say it, but yeah, more arseholes in people, behavior and things like that. So yeah, just kind of wanted to add on to that.
That's right. So choosing the right clients, Julian, is critical. And the right client is not the arsehole, to quote you, but is someone that's honest and is wanting to finish his project, make sure that he pays the builder on time every time as well, and understands the pressures that the builder is under. So, people talk about you can set up a trust fund that the client can put in all the money, or if it's a construction loan, then the money is out of the client's hands and in the bank's hands, which I'm not sure that's always it. The reality is, if the client objects and wants to start being difficult, then the difficulties are created for the poor builder. So it's all about knowing and understanding how to choose a right client compared to the wrong client. And I'll talk a little bit later on the balance of power and how to understand how a person behaves, a potential client, when they have the balance of power and they behave like assholes. Should you consider taking them on, when the fact is, if you hold the balance of power, they're nice as pie, but then when they control the situation, then they're just not very nice and they just treat you with contempt. So choosing the right client, having the relevant qualification criteria, checklists, and having process and procedures in place before you get lumped with them and sign a contract with them. How do you find the right clients? So a lot of businesses have that down to a fine art, but now is the time to get your head around it. And if you're not sure how to do that, maybe reach out after this webinar, and I'm happy to take you through some options, some checklists, and it brings to the forefront and the front of mind who you're dealing with and how that person's likely to react once they've got you over a barrel, or once you've signed a fixed price building contract, and how to make sure that you're not that builder that gets trapped. So marketing, once you've got your head around who's the right client for you and your business in this environment, who can afford you, who's happy to pay what they should be paying on time every time, then how do you make sure that you position your business as the right builder for that client, where you don't have free quotes provided on your website, for example, and you don't do decks, pergolas, new builds, renovations, extensions, multi-unit dwellings, and you're just putting it out there and hoping that someone good will come along. So getting crystal clear clarity as to who you want and how to make yourself the most attractive builder for that client that can afford to pay what you need them to pay in this environment. So client management tips, and I'm sorry to focus on clients, but they've been the end of many a builder and have been the cause of many a heartache to builders and those in the industry. Now, the reality is, even if the client is not paying you on time and is delaying payment for legitimate or otherwise reasons, the Security of Payments Act really puts a lot of pressure on the builder to make sure that you don't withhold payment for all your trades. And of course, there's law regarding your staff. So the builder is not receiving money, but is having to pay out the money. You can see how the debt trap becomes a reality very easily and very quickly, the cash flow trap, I should say, in this environment. So making sure that the client has their funds secured from the very beginning, and you're not sitting there spending endless hours, if you've got Buildxact software, or even weeks quoting a job that the person will never be able to afford to fund anyway. You may want to consider asking them for a copy of their credit file. On their credit file, you can see whether they have a history of non-payment, of late payments, of being bankrupt or being defaulted numerous times. And in this environment, you may want to reconsider whether you want to take them on board as your client. But there's no harm in asking for a copy of their credit file. You should consider or prefer a client that's dealing with a broker rather than a bank directly. And the reason being, if things go pear-shaped, either for you or for the client or whatever happens, a broker will be able to pull out rabbits from a hat and do second mortgages for short-term funding to get you through whatever the period is, or whatever the unresolved issue is, or whatever happens to that in that client's life that causes them to have financial difficulties. It's more likely a broker can find a solution rather than a bank that will most likely just revert to, I'm sorry, you can't have any more debt, and we're calling in the loan when they're halfway through a project, for example. So you need to make sure that you provide many options throughout the process for them to show that they're doing well and they're a good client, or to show their true colors, to show that when they need you, they're fine. When they don't need you, they block your number until they're ready to deal with you again. So managing clients, one of the biggest tips is to keep them informed. Open, honest, transparent communication always works well, especially before they become your client. And this is where I'm going to touch through balance of power, the relationship in the equation, which will help you figure out the type of client that you want to deal with. So Julian, if you would entertain me, when a client wants a builder to spend endless hours quoting a job because they had a thought bubble, who holds the balance of power?
During the quoting process, the builder has the power.
That's right. And many builders still don't charge for quotes, believe it or not. You've got to get your head around charging for quotes, which will help you in the short term as well as in the long term. So most builders do it for nothing. So when a client rolls out of bed and thinks, I think I'm going to do an extension, and they ring up the builder and says, can you quote me the extension? Or has got some plans and plans drawn up on the back of a serviette, and the builder's sitting there having to quote, you're right, the builder has the balance of power. What happens, Julian, when the builder gives them the quote?
Yeah, transfer.
The balance of power transfers to the client, and the client all of a sudden is not responsive, is not returning the builder's calls, and in fact might be shopping that very quote to every builder within Kui to try and beat you down to a lower price, and then comes back and says, I found a builder that'll do it for $1 less. What can you do? And so on and so forth. So try to think about who holds the balance of power at any stage, and how do you use this to your advantage to try out to see when, because mistakes do happen on site and in builds. That's just the reality and the nature of construction, unfortunately. So if you do make a mistake, is the client likely to be the one that just bends you over a barrel and takes advantage of you, or is the client as per when the client held the balance of power previously, likely to just work through the issue to have it resolved, and maybe, you share costs, or there's a win-win perspective on the world that comes from your client. So thinking about balance of power equations early on, before you sign up, is critical to the success of the builder and to the success of the project, making sure there's a win-win outcome for both. So knowing when to demand and knowing when to beg for things. Obviously, when you hold the balance of power, you're able to demand for information. You're able to demand for a credit check, for proof that their finance has been approved, demand that they finish all their fixtures and fittings before you start construction, as an example. These are all things that you can ask for when you hold the balance of power. But once you're in it, then, look, I'm busy, I'll get back to you. And you're sitting there saying, mate, I've only got a spot for you. I need to finish this project, and the customer's delaying you. Well, that's when you have to beg for things. So there's a lot of training that goes around client management that the builder can do. And there's a lot of support available if you're not sure how to do it. So again, reach out if you need help in any of these areas.
On that, Harry, before you jump off there, one of the things that I would recommend if you guys are using Buildxact is to get your template set up so that you can do a very, very quick, or a prelim sort of quote to a client. So you can get that quote done very, very quickly. It's really rolled up rates that you're adding on. And you sort of say to the client, hey, this is plus or minus 5 grand, 10 grand, 20 grand, whatever it is for the type of project you're doing. Get the client to kind of verbally agree that they're okay with that price bracket. Then potentially charge them for a quote and say it's refundable if they go ahead with it. And then you can sort of work on all the other documents. Now, if you get to that point, a client that is okay to get that far is probably not going to be a tire kicker. Now, there are always going to be ones that are around, but you've set your processes in place that you go, hey, I'm not sure what kind of intentions this person has, if I'm just being used to shop around or if it's a genuine quote. So I'm going to invest as little time as I can to give the client a range of price they're going to end up at. Once you got verbal agreement, then move to the next stage and the next stage and the next stage. Because, I spoke to someone a little while ago and spent 40 hours doing a quote and lost the work. And I'm just like, that is just an insane amount of time that's gone out the window. For most people that do, office jobs, that's almost a whole week of working, or it is a whole week of working for some people. So yeah, just kind of think about your own time and sort of systems and processes you can put in place. And if you're using Buildxact, really, really easy to get those templates up and running at a really basic level. And then you can always go away and do a proper formal quote once you've got the client 1 foot in the door.
Thanks, Julian.
No worries.
Opportunities. Now, the reality of this climate is it's not just for you. And what I mean by that is it's an unstable, messed up world for everyone. So we're all operating in the same environment. The clients are finicky because the banks are getting tighter, and the clients are getting harder to deal with because there's a lot of uncertainty in their own jobs, in their own worlds, in their own everything. But they're finicky for everyone, not just for you. There are people, unfortunately, out there that will be unable to afford the mortgage rate increases and will be unable to borrow money to buy a house, and will be unable to afford to pay for their existing mortgages. So the reality is the situation is being created where people will have to sell up because they have no choice. The risks to the economy are universal. They're not just for you and I. So all of this applies to everyone. Banks are slower to deal with, harder to deal with, but not just for you, for everyone. So giving yourself an edge in any of those areas, knowing that property prices are falling for the first time in 10 years, looking for developments where you can land bank, where you know that, sure, if I buy this project, this is a great project moving forward because it's going cheap because the person had to offload it. It may already have plans and permits. It may have been another builder. It may have been an accountant that reckons it's easy to do development projects, or who knows. But now's the opportunity where you look at punts that other people took and can't afford to retain or hold on to, And these are good times for you to snap them up, either as future land bank development opportunities, or if you're finding that things get even worse with clients in the short term, you may want to swing your trades onto your own projects as stopgaps rather than picking up terrible clients that you're looking at them thinking, my spider sense are telling me don't deal with this client. Builders usually have great gut feelings about other builders, about other people. And unfortunately, even though they have good gut feelings, it's rare that they go with their gut feeling. But if you happen to not go with a dodgy client and say, you know what, I've got a 6-month gap in my pipeline, I'm going to swing my trades onto my own project, which I managed to pick up for an absolute song, is a good place to be. But all of these opportunities that you can avail yourself to require funding. So I am biased when I say you need to cash up. You need to know what your financial situation is, get pre-approvals, access equity, have the funds available, because there are going to be massive opportunities as there are at the moment. But these opportunities, with every month that the rates go up, it means more opportunities for you if you're able to be fully cashed up.
Hey, Harry, just on that one, if you don't mind,
Sure.
and kind of speaking from someone that I assume maybe there are people on the call that's in the same boat as me on this one. What does that mean? So say right now I've got, say, about 200 grand of equity in my home, for example, and you're saying sort of cash up. What does that mean? Does it mean approaching, someone like yourselves, a bank, and just kind of saying, hey, how much can I get out of this to safeguard that I can dip into whenever I want? Is it?
No. So you need to make sure that the bank is comfortable or the lender is comfortable for the purpose you need the funds.
Okay.
So some banks specifically are not comfortable for you to say, look, it's my equity anyway. It's my house. It's mine. Why do I have to tell you what I want to use it for? I'm using it as a safety net, a just in case fund. Many banks are not comfortable with that and don't see it as a fit purpose. Other lenders or other banks are quite happy for you to do that and are happy to say, sure, I'll put it as a line of credit or an overdraft, or you can take it out and put it in an offset facility, whatever the case may be. But not all of them have the same lending policies. So what I'm referring to, Julian, is access those funds, but you need to be careful of what you say to your bank or lender in case they're not happy with the purpose that you're stating. So your broker is able to do a lot of that preliminary research and should know the bank's lending criteria inside out, and quite often better than the bank staff themselves. And so your broker will be able to say, look, why don't you do this with your bank? Or you could use it for maybe future investment purposes, which is what we're talking about with future opportunities, where the bank that says no to safety net will say yes to cashing up for future investment opportunities. So that's why I can't speak specifically, because it depends on your situation, and it depends on who you bank with, will depend on the purpose that you want to present them with, which is 100% accurate, but you need to term it in a way which is okay. And if I may just digress for one more moment, there's something called open banking at the moment, Julian, which means that whatever you tell one bank is now available to every other bank. So if you put in an application with Bank ANZ or whatever it happens to be with, and they decline you for whatever reason, and so the next bank that you put the application in with better be identical to the first one, because the second bank will actually be able to access your application. Now, I understand that the banks are meant to be competitors, and I understand that giving all the banks insight into an application that you put with a competitor doesn't make sense to you and doesn't really make sense to me either. But that's what is the reality in today's environment. It's called open banking, where all banks are able to share information on you with each other. So what you say to a bank is critical, because it will stay on file and can be shared amongst the other banks, which is why I strongly recommend that you speak to a finance an experienced finance broker before approaching anyone with anything and having that stay on your permanent bank record that can be shared amongst all the other banks. So, thank you. The golden rule on property, you need to remember, still applies. You make money on how you buy, not the way you sell, especially in this market where people thought property always goes up. So if you buy it at an inflated price today, it doesn't really matter because property goes up and so you'll sell it for more tomorrow. That's not the case. As we're living in at the moment, property prices are plateauing, if not pulling back. So if you buy a property too expensive, there's not a guarantee that you'll be able to make your money back. Whereas if you buy it at a cheap price or a well-priced price, then you've already made the money. So in this environment, the last little gems I'll share is think of innovative purchasing options. Now, for those of you that are of a similar age to me or older, will remember a time which was similar where you can negotiate with people for long settlement periods, 12 months, 2 years, which gives you enough time to get plans and permits in play through the council, which may take a while because there's delays there as well. It may give you enough time to get funding. It may give you enough time to figure out what's going on. And if you've only paid a small deposit to secure that purchase, then if things don't go well in 12 months, you can just walk away from that deposit without committing yourself to the full purchase. Not saying that that's what you should do, but that's what you could do. You can purchase with conditions being that you get suitable plans and permits through council, where if council knocks you back, then you have the ability of pulling out of a purchase. You're able to negotiate getting access to a property before it settles, which could save you months. So you buy the property and you get a demo team on, you get it all ready, and you're good to go. By the time the plans and permits come in, by the time you start paying the banks, you're nearly halfway through a project. These are all things that used to be on the table during similar times of hardship in the past. For the newer builders or the younger builders, you may not be familiar or ever seen these terms in play. These terms are fantastic for the builders. You might want to consider doing joint ventures with people. I know Chocolate often sets up doctors with builders. Doctors are very time poor, but they get access to drug money, pardon the pun, but they get access to really cheap funds that you and I could only dream of from banks. And they don't have the time to worry about projects and planning and they don't have the expertise, in all honesty. But when you pair up a joint venture with a builder that has the skills, the knowledge, the ability to do JVs and build the value, and it's funded by the doctor, it's rare that you don't see win-win outcomes through joint ventures. So this environment, even though it's very challenging, has huge opportunities and upside to those that take advantage of it and change their mindset to look for those opportunities and prepare themselves for the risks and the threats and look to springboard and gain a massive advantage. During times of uncertainty and upheaval are where profits are made and lost at the same time. So make sure that you position yourself to be one of those that use this time of uncertainty to springboard and leapfrog years ahead where you would have been if things were always predictable and the same. So it can be a positive time as well as a very challenging time. The conclusion is don't try and do this alone because it's very difficult to be a builder and run a building company in general. I know this for a fact because I've worked with you guys for many decades. So make sure that you partner up with an expert in finance, an expert business advisor or coach that's an expert in the building industry, by the way, not just a random in cafes or something else, because the building industry does require specific expertise and knowledge. Same with software. Don't do it the hard way, the old way, the way your dad used to do it or your granddad used to do it. There are easier solutions. As Julian said, you can pump out a quote in no time at all or a preliminary pricing request or whatever you want to call it. Don't do it the old-fashioned way. You don't have to nowadays. Get to know expert legal advisor, an expert accountant who has an expertise in accounting and construction, because by surrounding yourself with this sort of expert team is how you're able to leapfrog where you could have been going through the daily grind if things were the same, compared to this time of chaos and turmoil where you had vision, direction, and support from the experts to succeed in what you do. Thank you.
Thanks, Harry. That was really good advice. I think we've had a few conversations, and I always learn something from there as well. I didn't know about the front loading the interest rates for refinancing.
Yeah, so that's one of the unspoken truths that exist in the. It's a dirty little secret of the finance industry that you're paying off the interest for years and years and years, and a minuscule amount of principal, like negligible. So every time you refinance and you go to a new bank or a new lender, it resets, and you're just paying the interest again. And the poor borrower is, the principal is hardly being scratched every time they refinance. And the other thing is, there's nothing to say that you jump ship from, Bank A to Bank B because Bank B is offering you a cheaper interest rate. Well, it's variable. So there's nothing to say that you jump ship tomorrow and then they increase their rates and they're no longer the best bank. What do? Keep refinancing every 6 months? Doesn't make sense. So you need to have someone that's on your side that is able to go into bat with who, and a bank is a bank is a bank. There's no good bank in my view. And sorry if anyone's a banker on this discussion, but they're all the same. They take it in turns on who's going to be competitive and who's not going to be competitive. I won't go through the reasons at the moment, but happy to have that chat offline if anyone's curious.
Awesome. I don't know if we actually have any questions, which...
Great.
Let me just check just to make sure. Yeah, there's none actually in there at the moment. So guys, if you have any questions, feel free to add them in. Harry's really knowledgeable. So while you've got this opportunity, definitely get the questions in. Harry, one of the things there is one just coming in now. From Hamid. Sorry if I mispronounced your name, mate, but yeah, he's just saying that all was excellent. So that's good to hear. Harry, one thing I wanted to, and I kind of loosely touched on it before, with the amount of new people that came into the market with those low interest rates. How much of an impact is that going to have when those people are not able to buy? Say those people came into the market, they're on the market, and some of them might have trouble paying. But what kind of impact is that going to have with those new people not being able to continue coming into the market every year, especially for people that are probably building houses, at that more cheaper end? What kind of impact is that going to have with the amount of work builders have?
Devastating impact, because what they thought they could borrow before, they can't borrow now. And even though prices may have stabilized, the prices had gone up 20% year on year due to the materials and labor and the shortages. So these people will be left out of the market. The builders that used to build and cater for that market will not have customers that they can build for because their customers can't borrow, unfortunately. So it's going to have, look, the reality of our current situation where the Reserve Bank is increasing interest rates every month for the last 7 months. And their rationale is they're hoping that by taking money out of my pocket and your pocket, Julian, that we won't be able to spend money, which means that the businesses will stop raising their prices, and in fact lower their prices. So, because all they're trying to influence is the inflation rate, which is prices going up. So they're hoping if they take the money out of our pockets, we can't buy coffee, we can't renovate our house, we can't do anything because we're having $1,500 less each month, as an example, to spend. So we just sit on our hands and don't spend. Therefore, for a builder to give an incentive for a client to renovate or to build, the builder will have to drop their prices significantly for them to be able to afford to renovate. Now, the reality is many of those price rises have happened as a result of global issues, not local issues, like price rises for materials, as an example. So what that will do is the builder won't have new clients. The builder can't drop their prices because those prices they inherited from global issues. And yet the Reserve Bank will continue raising interest rates, which will lead to the builder saying, well, I can't have new clients. I can't afford to keep the staff that I have because I don't have any new clients. I can't drop my prices because they're fixed because of the external forces. So their only option is to sack staff. So the canary in the gold mine, Julian, will be unemployment rate. When the unemployment rate starts rising, you need to make sure that you're wearing a seatbelt and you're holding on, because what will happen is if prices don't drop for all those reasons, interest rates continue going up. Businesses, before they shut down, will let go of staff, which will translate in higher unemployment rate, which means we're heading towards an economic cliff and things will get very ugly very quickly. Unemployment rate is the one thing to look out for and hold on to. So before that indicator goes up, because it's still at record lows, cash up, mitigate the risk now that you can, consolidate your debt, set yourself up in case that's what's meant to happen, which will absolutely throw us into a recession and which will spiral onto itself. It will get very ugly very quickly. And when we look back, we'll be thinking, gee, we saw all the signs and that guy, Harry, told us that may be the case. We should have done something about it. Again, if you take the steps now, the worst case scenario is you just run a profitable business and you've got safety nets. There's no downside to it. But if you don't take any steps, the downside could be significant and will come upon us very quickly. Most experts talk about things, oh yes, in the past, and they're retrospective experts, and all they do is they revise their forecast based on what's actually happening. That doesn't help builders, especially, that need to be able to look ahead and look into the future and make decisions today based on what's happening tomorrow. Julian would have been able to provide some insight as to how to take advantage of the opportunities and how to shield yourself from the risks that may eventuate. And I hope they don't. But in my view, they're looking quite likely to occur because interest rates have been going up. It's like you scull 5 shots of alcohol and you straight after the 5th shot, you're standing up saying, hey, look at me, I'm not drunk. Yeah, but if you wait half an hour, you won't be okay. So I'm sure you can't relate to any of that, Julian, but it's the same thing. The Reserve Bank is just cranking it month after month after month, and it's having no impact at all on the inflation rate. Yeah, but with time, where we don't have money to spend because we're having to service the mortgage, that'll catch up with us and that will slam us. So, I don't know if that's a good analogy or not a good analogy.
Christmas is coming up, and I think I think it's not a massive country Black Friday here, but I think that's all coming up as well soon as November. I think that's on. So yeah, well, interesting to see. I've got a few questions for you, Harry, if you don't mind. So from Sherelle here, in a commercial construction setting, any suggestions on the best way to establish capacity to pay of the clients? Credit file of an individual doesn't apply to a business.
Well, you can ask for a credit file of the business.
Can you? Okay.
Yeah. So absolutely, does the business have issues? Is the business not paying what it's meant to pay on time, every time? How long is it for? You've got 2 years that you can look at a corporation's file, but in the commercial sphere, things can go wrong a lot quicker because there's more money usually at play. Having said that, in the commercial sphere, the ducks are usually lined up a lot tighter than in residential. And so the process and procedures often drive a builder, much more than they do in residential. Having said that, again, I've worked with commercial builders that don't have their process and procedures as tight as they should. And so when things go wrong, they go wrong very quickly in commercial because there's so much money that they're one claim gets withheld, and that could be hundreds of thousands of dollars, if not more, depending on the size of the commercial construction, that puts massive stress on the builder instantly. So, Sharala, I hope that helps.
Awesome. Thanks, mate. So Angelo here's said, most property analysts are forecasting property price falls up to 20%. Bloody hope not. In Sydney, Melbourne, within the next 12 months, as interest rates continue to rise. What is your view of the property prices, Barry? 20% would be a lot.
Say again?
20% drop would be a lot.
Well, it's not really, because before COVID, they went up 20%. So are they saying that there's over a 3-year period, it's cost neutral, they are price neutral? So they went up 20%, and they dropped 20% means that there's been zero gain or loss over the past couple of years. But look, the increasing interest rates are forcing people can't borrow as much. So have this explicit perspective of lowering interest rates, lowering property prices. So that's what they're trying to do. I don't know that 20% is what they'll achieve. Having said that, it depends on what type of property. So if it's high density, common apartments that you get a dime a dozen, then, falling 20% when they went up 20%, you could sort of see it, and there may not be a market for it. Whereas if it's blue chip property where interest rates going up and having $1,500 less in your monthly budget may not touch the side for prestige property, so is non-consequential, so shouldn't really have that much of an impact. The property market isn't one entity. It consists of, well, who's going to buy that property and how are they affected? The volume builders and that market, as you alluded to, Julian, will be significantly impacted, and I believe there should be significant pullback in properties at the lower end, but less so in the higher end.
Yeah, I was watching a video the other day about the property market in Melbourne. It was, people that, really, really higher end properties, and not even at the top end. It's just, people that don't have a big mortgage or maybe don't have a mortgage at all. Those people just aren't going to sell because they don't need to sell, and they'll wait, a couple of years until that property price comes back up again. So probably some of those properties won't change at all or not change much. But then, some of the ones that, where there's, you drive down and every house looks exactly the same. And, it's just all you see is dual carriageway. And like I've got that area near me, and it's, all the exact same houses. And then there's a Bunnings and a petrol station and a Woolies. And then you drive again, it's all the same houses again. I'd imagine those kind of properties are probably the ones that will probably be most impacted.
They will be. And the ones that, so there's a lot of people in the lower to mid market that are on the same job, and they're probably going to be on the same wages for a very long time. And there's no real, they're not self-employed, they're PAYG. And for them, they're just going through the daily grind. A lot of them, when they bought property, fixed the rates on, dirt cheap 2%, which is great at the time. But when they come off the fixed rates, I know that they won't be able to afford the current rates. So, will they rent? Will they try to sell their property at a loss? Will that, it's those properties. Well. Yeah, 2023 is going to be a very challenging, which is why I said after Christmas, January, February, March, there's going to be a lot of people coming off the fixed rates.
Yeah.
But right up in 2023, there's going to be, I can't remember, the billions and billions of dollars worth of fixed rates are coming off coming off fixed rates. Those are the ones that are going to be slam dunked, that will put their properties on the market, and they don't have the option of earning more money. They can't do anything really. They're just on wages, and even a wage rise of $5,000 is not going to make a difference when they geared themselves up with the highest possible mortgage they could afford at the time.
Yeah, I think I said, well, my friend, her mortgage is going up, $15,000 a year, which is just insane to think about that. Like, most people will struggle to save $5,000 a year. Maybe not most people, but a lot of people will struggle to save $5,000 a year. So to find $15,000 a year when you're already on your max of what you thought you could repay, it's going to be tough. But another question here from Hamid. Sorry, mate, again, if I pronounced that wrong. But saying I bought a house 2 years ago, plan to subdivide and build 2 townhouses at the backyard and keep the existing house. The increasing interest rate is a killer. Should I still go ahead and borrow or just forget about it for now?
So, Hamid, I assume that you're a builder. I don't want to give you specific advice without knowing your situation, but just general advice, if that's okay, to answer a similar question, which I'm sure many people have. If you plan to subdivide and build 2 townhouses on your backyard and keep the existing house, well, if you've got no other choice and you can't get any other business and you can't get any other clients at the moment, then the choice is pretty easy. Are you maximizing the upside for that development? Well, you're probably not maximizing it because the sale price won't be at a peak, because we've just spoken about how property prices have come off the boil. So if you can borrow and you can't get clients, then sure, what other options do you have? But the reality is, it's not, I assume you bought it as the stopgap that we talked about 2 years ago, and you thought the property prices are going to keep rising. Well, if you can keep funding your business and growing your business with quality clients and having this as a stopgap, then that's not a bad position to be in. But you're probably not going to realize the highest value and the true value of the project when you initially bought it 2 years ago. Assuming that you can borrow, of course. I mean, so happy to have a chat more specifically about it with you once I get a better understanding of the situation. I hope that helps, and that's as specific I can be with you at the moment.
Thanks, Harry. There's no other, or there is actually just one that just, I said thanks. There's no other questions there, but I've got one as well, actually. You know, with these interest rates continuing to rise, and obviously it seems like they're going to continue rising them until we get some sort of control on that inflation rate.
Or we're in a recession.
Or a recession, yeah.
They're the 2 options, right?
Yeah. And what do we need to start seeing for those interest rates to come back? Like, what are the kind of things that, you know, they look at in terms of trying to say, okay, we don't need to increase it anymore? Or like, is there a percentage drop, or is it?
Yeah.
You know?
So the Reserve Bank has a target of the inflation rate being between 2 to 3%. It's now 7%, forecast to hit 8% by the end of the year, 7.85 or whatever it is, but the forecast has been revised up to 8. So the Reserve Bank only has one tool in its toolbox, and that's to raise interest rates. That's all it can do. So all it will continue doing until the inflation rate drops to 2 or 3%, between 2 to 3%, is raise interest rates. And if you think about our election years and what our governments do, they've got all the other levers that they can pull that will influence this. Everyone does stacks on the Reserve Bank for how can you raise interest rates. They can't do anything else. Whereas if the Reserve Bank keeps raising interest rates and the government keeps on giving out grants to stimulate spending, then you can see, I think the analogy has often been used that when you're driving a car, if you've got your foot on the accelerator, which is the government giving stimulus, giving grants, and trying to get people to spend, that's the foot on the accelerator. And you've got the Reserve Bank putting its foot on the brake, which is raising interest rates, then I'm not sure if anyone's tried it. It's not very pretty. The outcome's not very good. So even if unemployment rate, you know how I said that's the canary in the coal mine, even if the unemployment rate starts skyrocketing, if inflation is still at 8%, then the Reserve Bank, all it can do is raise or drop interest rates. It's got nothing else. So, you know, is it going to drop interest rates when unemployment's going through the roof? Well, you would think, because that will stimulate jobs because money's cheaper, but unemployment isn't in its targeted, that's not why it exists. It only exists to control inflation. The inflation monster is all it's trying to address. The whole world can go to hell in a handbasket and the Reserve Bank will keep increasing interest rates until inflation comes between 2 to 3%. So the heavy lifting should be done by governments. And this isn't me being political. I don't mind who does it, just as long as someone does it, please. Where just think about how do we make the decision of whether are the price rises domestic, or whatever we do with rising interest rates, it'll have no impact on rising prices, and consequently the inflation rate will continue going up, and the government needs to come up with better policies on handling the situation than just saying, oh, well, people are struggling, I'll give more money and incent people to spend. Well, interest rates will just keep going up is the answer, Julian, to your question, unfortunately.
Interesting next 12 months or so.
Should be very exciting, lots of opportunities for people. And this is where great wealth is made and lost, but this is where it's made. Line your ducks up, cash up, look for those opportunities that won't come around for another 10 years. Every 10 years, we seem to have a crisis. So, you know, in Melbourne especially, you know, we've had COVID, we've had earthquakes, but just gear up, because I think this is a great opportunity for people to take advantage of the uncertainty, of the turmoil, and the opportunities which will avail themselves because of the turmoil that exists. So just be ready, be prepared. You're in a tricky industry anyway, being in construction, but so you're pretty good at juggling multiple balls, I would assume, up in the air at the same time. So just mitigate your risks, run your business better, and look for the opportunities to capitalize on, and just leapfrog years ahead of where you would have been otherwise during this time is my only message.
Awesome. Thanks, Harry.
Thank you.
Guys, I don't think there's any more questions. So if you have any now, definitely pop them in, but I think we can call it there, Harry. But that was great session. I always learn a lot, as I said, and you know, I'm going through a process of potentially looking at buying a place now. So this chat has been really
opportunities, Julian.
Yeah, exactly. So I just I'm now in a position where my wife's back to close to full-time work after having the baby. So a bit more money to play around with in our house, provided I stop spending money on stupid things. But yeah, thanks everyone joining. Yeah, Cheryl just popped in there. Thank you as well. Guys, there will be a recording of people that were actually on this call. We're not going to make it completely open, at least in the short term, as we have done in previous webinars. So if you're not able to get the recording that you want to see directly, reach out to me and I can make sure you have it. But we're going to gate this one, so it's not going to be widely available as the previous ones have done, just because there was a little bit more. Harry didn't say advice, but there's some key points in there that yeah, we've tried to keep it to the people that are actually joining on this call. So thanks for joining. I know it's sort of getting to that kind of crunch time of the year where everyone starts to wind back and doing anything else and just focusing on getting the projects done for Christmas and whatnot. So really do appreciate your time. Obviously, if any of you are looking at Buildxact as a software solution, if you're worried about time and managing a project sufficiently, we're the software for you, especially for a smaller builder. Most people that end up signing up for Buildxact are people that think they don't need software. So if that's one of you and you're building two homes a year and you're thinking, oh, I'm too small for software, you are perfectly fine for software and you probably need it. And then obviously for Harry, I don't know if you want to do a bit of a plug there in terms of how people can reach out to you before we duck off. chocolatemoney.com.au. Sorry, swallowed wrong. Thank you. Thanks, everyone. Have a Merry Christmas if we don't speak before then. Thank you, Julian and Buildxact. No worries at all. Thanks, I really appreciate you coming on. Thanks to everyone for joining us as well. I appreciate it. Cheers. Bye-bye.